Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm taking a look at Paycom Software. This is a company that I've liked for quite some time. I could just never make sense of the valuation. And now the stock is down 37% today after the third quarter earnings results. So I wanted to see if the earnings were as bad as a 37% drop would make them seem, or if this is an opportunity to at least set an alert or even buy the stock. So like I said, stock is down 37% today. Year to date down 50%, 1 year out down 55%, 5 years out still positive, but you can kind of see that this stock peaked at $550 during that bubble, I will say, after the pandemic when interest rates were really low. Now interest rates are rising, valuations are coming back down to earth, and these companies that aren't growing as fast as they were growing are being punished. And you can see that some of their competitors, ADP, Paylocity, Paychex, are kind of down in tandem. And then Paycom, as far as ADP and Paylocity and Paychex go, Paycom is probably one of the smaller players in the HCM space. They do HR software that helps with payroll, that helps with talent management, talent acquisition, HR management, etc. The software as a service business, so lots of recurring revenue. That's why the market likes it. It's high margin, recurring business, and it's growing at a pretty decent clip. But now that growth is slowing, interest rates are rising, and the market is re-evaluating these companies quite a bit, as can be seen by this 37% dip. So revenue still up 22% from the prior period. That's not terrible. 22% is still pretty good, but they guided for 25%, so it's a bit of a slowdown. EBITDA is still pretty good, 40% margins here. Decent results on the GAAP income side. Cash and cash equivalents are solid, so the balance sheet is really good here. Pristine, basically. $484 million on the balance sheet in cash, only $29 million in debt. As you look at the outlook for 2023, Q4 is a bit of a miss on the revenue side. And then as you look at 2023 in total, they were guiding closer for 1.72 billion in revenue. They're actually going to guide now to 1.68 billion in revenue. So again, a 30 to 40 million dollar miss isn't a huge deal, but as that compounds across the years, the market starts looking at this company a bit different. And especially when on the earnings call after this release, they announced that 2024 growth is only going to be 10 to 12%. And that's not bad by any means. 10 to 12% is still pretty good, but this is a small player in the HCM space. If you look at ADP, ADP is 19 to 20 billion in revenue. Paylocity is relatively small. Paychex is maybe 5 to 6 billion. You're talking about a company here that has maybe 5% market share, and they're only growing at 10%. They should be growing faster than that. They should be taking market share. And one of the things they said on the call is that one of their products, Betty, that they released in 2021, it's a payroll product, is working so well for customers that they're having to make less corrections on their payroll. They're having to rerun payroll less. And these are all things that Paycom basically bills for. Every time you rerun your payroll, Paycom makes money. If they have a product that is causing companies and employees to make less errors, Paycom makes less money. So even if they're selling this product, the adjustments that are being made for this product are less than they used to be on other products, and they're making a bit less money because of that. So again, they're successful in that product. To me, that seems like, well, this is a great product. Shouldn't you be selling that to a lot of other companies and telling that story? And maybe that's the long-term play. But right now, it's kind of hurting them from a growth perspective because the product is really solid. Yes, they're selling it to new companies, but I think we're also entering a period of time in the economy where things are basically going to slow. It costs quite a bit of money to change your HR system to something new. That's a good thing for renewing an HR system, but it's a bad thing for companies like Paycom when they're trying to get into the HR systems of new clients and they're less willing to take that expense even if they're offering a good product. And that's simply the case right now, could simply be the case right now, because if the economy is slowing, if companies are spending less money, they're just going to say, listen, we can't afford the disruption right now. We can't afford the expense of the installation of this product. Yeah, maybe it's better, as you say, and maybe some companies will buy it, but perhaps they're entering a period of slower selling seasons. And until the economy recovers, this might be a stock that's not as growthy. It's not a word, but let's say as growthy as it used to be. And that's kind of what you're looking at here. You were expecting about 18% revenue growth for 2024, 15 for 2025, 12 for 2026. And now as you look at 2024, you're only going to get about 10 to 12%. That's way below what you expected. And as that compounds out into 2027, maybe the expectations were that this company is going to have about 2.9 to 3 billion in revenue by 2027. As your growth slows down every year, kind of ticks on through, maybe you're at 2.5 billion. So that's a big miss on the revenue side in the long run. Obviously, the expectation could be as an investor that they're going to have slowing growth in the short term, but when the economy recovers because their product is so good, they can start growing again, they can start improving margins again. And maybe that's true, but we're not seeing that right now, and that's why the market is doing what it's doing. And as I look at this stock, as I look at the valuation, as always, disclaimer here, this video is for informational purposes only. It's not investment advice. Do your own due diligence before investing, and do not treat any opinions expressed in this video as advice to follow a particular strategy. As I look at this stock, as I look at where it was priced before, this is a company that's generating about $200 to $300 million in cash flow right now. Growth is starting to slow, and you can kind of see I have that growth expectation toned down versus what this is showing. So this kind of speaks to what I was saying before. The estimates here had this at 2.9 billion in revenue by 2027 because of the slowing growth in 2024 and expectations that that growth is going to be lower than it was on the estimates. I'm only at 2.5 billion rather in revenue in 2027. So that's a reduction of 15%. So that kind of explains why the stock is moving as much as it's moving. On top of that, obviously it generates a lot less cash flow because your margins are still staying relatively steady, but they're coming off of a lower top line base. And some of these estimates here, there's no way they're going to reach 32 or 36% revenue margins on the free margin side. It just doesn't make any sense. In any case, the stock market is still giving it a pretty hefty multiple. I don't know if it's fully processed the fact that their growth is really going to come down. I'm not saying they should get a market multiple like ADP that's in that 5 to 6% range, but maybe in the long run, that's what they should be getting. And that's kind of what I'm assuming here. So I think ADP is somewhere in that like 6.5% range as far as free cash flow yield goes after today's cut. That's an interesting stock as well, one I might review. But right now, this is still getting a 2.5% free cash flow yield based on 2022 actuals, maybe a bit higher based on 2023 estimates. As far as buybacks go, they have made some buybacks in the past, but a lot of it is washed away with stock-based compensation. If you look at this free cash flow, maybe it's 200 to 300 million, but there's about $100 million in stock-based compensation that is cutting into that. That is a non-cash expense that is making their free cash flow better, but it's something to consider because it is dilutive in the long run to have that much stock-based compensation. They did just issue a dividend this year. It's 37.5 cents per quarter. That's about a 1% yield at today's prices. I'm expecting they're going to grow that at a relatively decent clip. When you think about their dividend payout ratio, it's only about 30%. And as their revenue grows, as their free cash flow grows, they can probably throw off a 10% increase every year. That's kind of what I'm assuming. It's still not going to be a huge dividend yielder, but it could be a good dividend grower in the very long run if they continue growing at a decent clip. Because I do think Paycom has something. They have a pretty solid product. They have a good balance sheet. They can make acquisitions. They can buy back stocks. They can invest in the business, add additive software to their HR software stack. And they only have about 5% of the market share right now. So there's plenty of opportunity for growth. Is this slowdown a forever thing, or can they keep growing? It's tough to tell. For now, I can only assume that it's going to be kind of the new norm. So they're dropping from 22% growth in 2023 down to 11% in 24. They'll give more guidance on that in the next earnings call. So that's something to look forward to. But for now, this is all I can work off of. And then I'm assuming similar growth for the next couple of years. I'm assuming some margin improvement. If you look at some of their competitors, as you look at ADP, ADP kind of matures in that 19 to 21% range, depending on the year. Sometimes a bit higher. Certainly they can cut back costs, but they're going to be investing a bit more money. The question is how much of this is going to be used towards stock buybacks. They're at the very least going to offset the stock-based compensation that they have out there, but I'm assuming they're going to do a bit more. They do have $1 billion in stock buybacks authorized right now, so you may see this 500 million in buybacks and say that's not enough. But again, this is on top of the stock-based compensation dilution. So if they're going to issue 100 million a year for the next 5 years, and then they're going to buy back about $1 billion, essentially, the overall result is going to be half a billion in buybacks. So as I look at it this way, my scenarios here, again, what kind of free cash flow yield does a business like this deserve? If it was continuing to grow in that 20% range, even high teens, I'd say 3 to 4%. But now that it's starting to slow and potentially go into that high single digit, low teens space, I'm saying it's more in that 4 to 6% range, basically 4 to 5% range. The overall free cash flow yield I'm pricing this to is about 4.8%. If I'm targeting a 10% return, the fair value of something like this is still only about 112 bucks. And maybe you can say that this should get a better multiple because, again, it only has 5% market share. It can grow from here. Sure, you can make that argument, and at that level, it's about a 13% return. But with this assumption, with this 4.8% free cash flow yield averaged out against a 5%, 4%, and 6% yield, depending on the weighings here, I'm only assuming about a 4.5% return from today's price point of 153 bucks. So that's not enticing at all. I would need something more, essentially a lower price for me to be interested in the stock. And that's difficult to say when you talk about a stock that just dropped 38%, but that's just kind of reality to me. Based on what they said about 2024, the fact that they're already starting to see really slowing growth tells me that the economy is starting to slow, that businesses are spending less money on things like new HR systems, and that may continue into 24 and 25, and potentially there's some upside here if they start growing in 26 and 27. That would be the thesis for buying at today's prices, that hey, yeah, there's going to be some slowdown in 24, some slowdown potentially in 25, but then they're going to expand again in 26 and 27. They have a lot of market share to take. They have this great product that is actually reducing their revenue because of how good it is, and they're going to grow from here. So I can see why you would make that argument, but for me, I just don't see it in the numbers, and I'm a numbers guy. So if I'm looking at a potential 4.5% return at today's prices, it's just not very enticing. So for me, I think I'm going to put an alert for this company in that $112 range. At that point, that's maybe an 11% return because this is pre-dividends. That seems very interesting. Like if I put 112 bucks here, right, I get about an 11% weighted expected return. That would be interesting to me because even if if there's multiple expansion, you could get to 20%. Even if the multiple shrinks a bit, it's still in the very positive range. So at 112 bucks, would I be interested in this? For sure. At $153, am I interested in this? No. What do you think, guys? Do you think I'm off my rocker here? As always, guys, please do your own due diligence before making any investment decisions. Let me know if you like this video, what you think about Paycom. Leave a comment down below. As always, like and subscribe. Welcome to all the new subscribers from my other video that got a lot of views. Hopefully you enjoyed these videos. I will leave this spreadsheet in the description down below. You just hit file and make a copy if you want to play around with it. All of my stuff is always going to be free. I'm never going to charge you for any of these spreadsheets or anything like that. So hopefully you have some fun with these. Let me know if you have any feedback on these spreadsheets as well. I would like to make them better, and I continually do add things to these spreadsheets and make changes. So if you're watching this video in the future, there's probably going to be massive changes to the spreadsheet that aren't reflected in this spreadsheet, but are reflected in videos going forward. So Paycom, let me know what you think. Are you a buyer at today's price? Are you waiting for something lower? Are you upset about the big stock hit? For me, fair value at 112 bucks seems about right, and I'm going to leave a alert for myself. And if that price point is hit, this is probably one I would buy. But I think it's going to be heavily impacted by any economic slowdowns as businesses tend to spend less during that period. And maybe that's already happening and it's being shown in some of these results because these are the companies that are working directly with the businesses, small businesses, large businesses. And if they're buying a bit less, if their cross-selling results are a bit less favorable, maybe that's kind of the new norm for the next couple of years and it has to be reflected in the price. And hopefully doesn't fall too much for current shareholders, but if it does, I'll be interested. So thanks for watching, like, subscribe, and have a good day. Bye.